Monetary policy tools, what are they all about? So, first we have open market operations. This is basically the central bank, which is separate to the government, buying and selling bonds on the open market. Basically, it's like Monopoly. The central bank, they can go boop and create money. They can use this money then to buy bonds from the government. What are bonds, you ask? Well, let me tell you. Bonds are basically a little bit of paper that says, I owe you this amount of money. Anyway, so now the central bank has basically given the government a loan. Lucky government. They can now use this money for fiscal policy, which means they can spend more in the country and create jobs and fix roads and whatnot. This generally boosts the economy. On the other hand, if they want to shrink the money supply, the central bank can just sell these bonds. And these are bonds that they already own. Other people will buy these bonds for a good price. And then it means they won't invest in other things because they've bought these bonds and they need to hold on to them. Number 2, discount rate. The discount rate is the rate at which the central bank can say to other banks, I will give you a loan. So if the central bank say, you know what, you're my friends, we'll give you a loan for 2% instead of 3%. That means the bank can borrow from the central bank at a cheaper rate and then lend to you guys at 5%. That means they're going to make a big profit on the interest repayments. In this case, they'll make 3%. So this means the commercial banks, the businesses, are more willing to borrow from the central bank because the loans are cheaper and there's more profit to be made, and they'll loan more out to you guys. And if the central bank want to stop the money supply, they will do the opposite. They will increase the interest rate so banks won't borrow from them, and therefore banks will lend less to you. And if they do lend to you, they'll lend it at a higher interest rate. Next, reserve requirements. Now, if a central bank want to expand the money supply, they can lower that reserve. So they can say to these banks, you know what, actually, instead of you needing to hold 10% of people's money, you only need to hold 5%. This frees up extra funds and they can start giving it out and lowering interest rates and having more money available for everybody. This means people borrow more money and spend more money and the economy does better generally. On the other hand, if they want to stop the money supply and pull the money back in, they need to increase interest rates. How do they do that? They say, you need to hold on to more money now. So they force them to hold on to more money. Therefore, they'll give out less loans at higher interest rates. All right, the final one, interest on reserves. Think about what a commercial bank wants. They want profit, right? So a central bank needs to control this mechanism. So the central bank can say to them, I tell you what, if you don't give out your money for loans, we will just pay you 4%. We'll give you more money to hold on to it. This will stop the bank from giving out loans. And if they do give out loans, it's high interest. So that will control the money supply and keep it in. However, if the central bank want to expand the money supply, they can say to the bank, look, we was giving you 4%. Now we're only going to give you 2% for holding your money. The commercial bank's going to think, what? That's not fair. I'm just going to lend it to people for 5%. I'm going to make more money from doing that. So then they give out more loans at lower interest rates, expanding the money supply, and the economy should pick up from that. So in conclusion then, these are the 4 main tools. Have a great day, and I'll see you again.